that the typical way recessions were triggered in the past were through either monetary policy tightening or because of excesses that have built up in the financial sector. I will argue that neither is likely to trigger off the next recession. Instead, the forces will come from elsewhere, and we'll talk about that in a second. The normal end to the business cycle in the 60s and the 70s were tight labor markets, wage inflation, falling profit margins, and then as inflation picked up, the central bank started tightening, which caused firms to start firing workers, reduced consumer confidence, consumption fell. That's not been the way the last two business cycles have emerged. The last two business cycles had some central bank tightening first, but then it was exacerbated because there had been a lot of financial sector excess that had built up. In the early 2000s, it was the dot-com boom and bust. Stock markets are very, very high, and that precipitated the downturn. And in 2007, 2008, it was the global financial crisis. Now, today, I will argue that even though financial sector risks have built up, as Governor Zhou pointed out, they're not at a level that they will be triggered off without financial market tightening, without monetary policy tightening. And what the central banks have done is they've taken tightening off the table. They have said, we're not going to tighten for the foreseeable future because they want to support growth. And they can do that this time around because inflation is still not a big factor. I think it's also central banks have become more patient. The leading central bank is, of course, the Fed. The Fed has become more patient because, in a sense, it's in a tussle with the US administration. The US administration has set the Fed up for being the scapegoat if there is a recession. We get constant tweets from the White House about how the Fed is not doing its job, but clearly, if there is a recession, the finger will be pointed at the Fed. Now, I don't think this is this is the most important input into Fed policy making, but at the back of the minds of Fed governors will be, if there is a recession, we will be blamed. Let us not drive the economy into a recession. And so what you saw towards the end of last year, the beginning of this year, was the Fed turned around 180 degrees. From wanting to raise interest rates steadily, it has moved to cutting interest rates 3 times. And that has been an important supporter to the thesis that I'm putting forward on the table, that the central banks are not going to tighten and drive the recession. The central banks are not going to stop growth. Now, this has a cost. This is not costless. In the easy monetary environment that we have, financial sector risks are building up. Leverage is building up even in the corporate sector. And so when the recession actually comes, it will be a deeper recession because some of these risks will come to the fore at that point. So where will a recession come from? I would argue it comes from 2 other possibilities. One is serious policy mistakes. And the primary policy mistake we can see happening is trade. The news on trade has been hopeful over the last few days. Some discussion about moving down the tariffs on both sides in the United States and China. But it's not over yet. A second possible risk is geopolitical shocks. We saw an example of that when we saw missiles hitting Saudi Arabian oil fields. There was enough spare capacity in Saudi Arabia to get us back on track quite quickly, but it does show that Saudi oil fields are vulnerable, oil fields in other parts of the Emirates are vulnerable, and if in fact there is more of a conflict in the Middle East, oil could be affected, and that would be another factor that could precipitate a recession. So the bottom line I'm arguing here is the actions of the central banks in reversing their normalization process, which was taking place in 2018, ever since the global financial crisis, central bank powers to fight such a recession have in fact become more limited, especially in the non-monetary side, in rescuing entities that have gotten into trouble. So it's going to be more difficult for that reason. Second, a number of industrial countries have very limited fiscal room, and therefore the kind of spending that took place in 2008, 2009 is again going to be more difficult because the fiscal room has become much more limited. And of course, post-global financial crisis, we had summits like the G20 summit in London, which allowed for a multilateral response to the global financial crisis. If in fact we have a deeper recession the next time around, it's going to be much harder to coordinate that kind of global response because of the kinds of difficulties between countries.